In this video, we're going to talk about how firms make money. To be more specific, we're going to talk about how much money firms get to keep. Let's begin with an example. A trendy t-shirt designer produces t-shirts for $20 a piece. The t-shirt designer sells the shirts for $40 a piece. How much money does the t-shirt designer get from the sale of each shirt? You're probably thinking that this is a simple problem and that the t-shirt designer gets to keep $20 for each shirt sold. However, we do not have all the information we need to figure this out yet. So far, we calculated the contribution margin, which is the sales revenue minus variable costs. In this example, the sales revenue is the sale price of $40 per shirt, and the $20 is the variable cost to produce each shirt. Before moving on, let's take a moment to discuss the basic accounting principles of variable and fixed costs. This will help us as we move through the rest of this example. A variable cost is something that a firm incurs each time they sell a product. It is called variable because the total amount of variable cost changes as the number of products sold changes. Examples of variable costs include raw materials, shipping costs, and salesperson commissions. These costs change or vary as the number of products sold changes. A fixed cost, on the other hand, is a cost the firm incurs regardless of the number of products sold. Examples of fixed costs include rent, insurance, and manufacturing equipment costs. These costs are fixed. The firm will pay the same amount whether it sells one product or 1 million products. Now that we've got that covered, let's return to our t-shirt example. We already know that the $20 used to produce the t-shirts are the variable costs. What we don't know is what the fixed costs are. In order to determine how much money the t-shirt designer gets to keep from the sale of each shirt, we need to identify their fixed costs. After talking to the t-shirt designer, we learned that they design, produce, and sell t-shirts out of a converted warehouse. The total of all the fixed costs for the trendy t-shirt business are $100,000 per year. Now, we have all the information we need to figure out how much money they get to keep from the sale of each shirt. We have $40 in sales revenue per shirt, $20 in variable costs per shirt, which gives us the $20 contribution margin per shirt, and we have $100,000 in fixed costs per year. Next, we need to perform the correct calculation to figure this out. This formula is referred to as the break-even point. The break-even point formula helps us figure out how much money we need to make in order to cover all of our costs, both fixed and variable. That is the break-even point. Then, once we pass the break-even point, all the money that's left over is the money that the firm gets to keep. That's the profit. Before we calculate the break-even point, let's talk about the break-even point from a theoretical perspective for a moment. You can think of the break-even point as a bucket. You are trying to figure out how much money you need to put into the bucket before all of your variable costs and fixed costs are paid. Once you put enough money into the bucket to pay all the variable costs and fixed costs, your bucket will be full. You will have reached your break-even point. All other money, the money that does not go into the bucket because the bucket is full, is the money you get to keep or reinvest. Okay, so here's the formula you need to use to calculate break-even point to fill the bucket. Total fixed cost divided by the contribution margin per unit. In our example, we already know the denominator. It's $20 contribution margin per unit. So to put the formula together, we have the $100,000 in fixed cost divided by the $20 contribution margin, which equals 5,000 t-shirts. The t-shirt designer would need to sell 5,000 t-shirts a year to break even, to fill their bucket. To keep any money from the t-shirt business, to make a profit, the designer would need to sell at least 5,001 t-shirts. Every t-shirt sold after the 500th t-shirt is profit. How much profit? $20 a shirt profit, starting with the 501st t-shirt sold. If the designer sold 7,500 shirts this year, they would get to keep or make a profit of $50,000 this year. To calculate this, first find the break-even point, which was 5,000 shirts. Subtract the total number sold from the break-even point.
7,500 shirts
minus 5,000 shirts equals 2,500 shirts. Then multiply the 2,500 shirts by the $20 per shirt contribution margin, and that equals $50,000 for the year. You can use this same analysis to estimate profit by changing the total number of products sold to see how profit changes as there's changes in sales volume. Let's see how much money the designer would get to keep if they sold 15,000 t-shirts instead of 7,500. In this case, the break-even point remains the same, 5,000 t-shirts. Next, subtract the total numbers sold from the break-even point. 15,000 shirts minus 5,000 shirts equals 10,000 shirts. Multiply the 10,000 t-shirts by the $20 per shirt contribution margin, and that equals
$200,000.
In conclusion, to determine how much a firm gets to keep to make a profit, you need to find the break-even point. To do that, you need the contribution margin and the total fixed cost. From there, you can determine how many units your firm needs to sell to fill their bucket and how much money it gets to keep once the bucket is full.